Top three things this morning are number one, Germany, number two, the 10-year bond yield here in the U.S., and then finally, the most important thing that's driving the correlation trade in the market, which is absolutely huge at this point, is the U.S. dollar. So first, let's just get into what's going on in Germany. If you didn't know that deflation equates to lower bond yields, now you know. German yields down to record lows on the 10-year, breaking 0.30% to 0.29%. You're seeing a waterfall of downward bias really in bond yields on that. Don't forget that this is reflecting on what's going on in the world. No, the U.S. is not in its own echo chamber. Global growth is slowing and you have deflation. Those two things are negative for bond yields. If you've had that on for a year and you buy every pullback in long bond securities, you've made a lot of money. So let's stay with that. It's a lower volatility position to have really than chasing the Dow. And at the end of the day, if you're a macro market manager, you won't want to just stare at the Dow anyway. Point number two would be the 10-year bond yield in the U.S. Now, we've seen a 17 basis point drop week over week going into what we thought would be a very bad CPI number. Now, CPI slowing equates to deflationary pressure. It also pushes the Federal Reserve to say more of what really concerned the bond market in yield terms this week, which is Janet Yellen being concerned about what she should be concerned about, which is inflation not achieving her quote-unquote 2% target. Now, today's CPI is another made-up government number. They actually changed the entire calculation. We're going to get into that. But the point is that you can't get to her 2% math. You can't get to 2% CPI or inflation in Europe either. So what you're going to have is both Europe and the U.S. reflecting on misses versus their expectations, quote unquote, or what you see on Twitter or on some television channel on missing consensus or missing expectations. Let me give you an expectation. Inflation will continue to miss their expectations and will continue to surprise on the downside. So again, you want to be long the long bond on that. Finally, just to hit on the U.S. dollar, the U.S. dollar came under pressure quite quickly after Janet Yellen started to speak. We went through this yesterday again. She did not remove the patient language. She talked about inflation pressures, and she's really said that she'll be data dependent. So again, if you look at why we said the dollar could get under pressure for a couple days, it was specifically just hawking the calendar. If you don't have calendar catalysts in your notebook, A, get a notebook, B, get some catalysts and write them down, and then C, have a view. So again, it's not enough just to know what's going to be reported. The key here, and it's critical, is to front run the mainstream by having a view on what those calendar catalysts will do to both the bond market and the foreign currency market. If you get both of those things right, you also will have a chance to get the stock market and or the components of the stock market right. Again, this is not the 1980s or the 1990s or 1802. This is modern day markets, and again, there's macro markets that are affecting a lot of different things that are happening to the equity market. So please evolve your process and get in line with us on that. So those are your top three things.